So LMI, what is it and how is it calculated?
Great question again. So LMI, Lenders Mortgage Insurance. I guess to explain it in a very basic term, it's an insurance, right?
Yeah.
Banks have to take this insurance because they classify any loan which is over 80% of the value of the property as risky or higher risk. So the idea behind LMI is that if they lend someone 85%, 90%, 93%, they have gone into a higher risk category loan. If that customer has some difficulty in future, any life situation or whatever, and they can't repay their loan, worst case scenario in that situation would be that bank has to repossess that property back from them and sell it to get the money back.
Yeah.
Unfortunately, in a lot of those scenarios, bank is still short at the end of the process because it's not like a quick thing.
No.
If they have to go and repossess, sometimes it can take up to a year before that can happen.
Yes.
For that one whole year, there has been no repayment, so that interest is capitalizing and that loan is getting bigger and bigger in the background. There's obviously, legal costs involved, there's time spent, money spent. So when you add it all up, they might need 100K more than what the outstanding loan is to cover everything. And usually they won't get it. So there's going to be a shortfall at the end. If that ever happens and there was a lender's mortgage insurance policy on that loan, bank will then contact the insurer. Insurer will look at the detail and they will bridge that gap for the bank. So bank is secured, so they can still lend to those people who have lesser deposit. So clients need to look that as an opportunity cost, that hey, I don't have 20%, but I can still get a loan, I can get the property, and if I can get it at the right time with the right property, I'll make my money in the appreciation in the long term. So that's essentially what LMI is. Like every other insurance, higher the risk, higher the premium. So the best example I can give is, so for example, you are a 20-year-old person, you bought your first car, and you want to get insurance on your car. What will be your premium? Same car, same year, and a 40-year-old person who is driving for last 25 years with clean record, what will be their premium? Obviously a lot lesser. Same car, same value, but premiums are usually different. Why? Risk here is higher, risk there is lower. In home lending scenario, the risk is based on what is the value of the property and how much bank is lending you against it. The more they are lending you, higher the risk. So every percentage of loan going up is increasing the risk. So the higher you're going, the premiums are going up. So for example, if somebody took a loan at 82%, they'll still pay lender's mortgage insurance, but it'll be tiny. Whereas someone who is borrowing 94% of the property value, they might pay the highest possible LMI, and it also depending on the value of the property. So 90% of a $500,000 property is not the same as 90% of a $2 million property. That LMI will also change again. So that's how it's kind of roughly calculated.
Okay. And what are the pros and cons of LMI?
Pros, well, there's not many pros apart of it allows you to obtain the property with reasonable deposit and don't have to wait for another few more years until you get to 20%. Because vast majority of people think that they can't do anything until they have 20%, which is not right. We do quite a lot of first home buyer loans in our team. And look, I don't have the exact number, but I would say that good 60-70% are borrowing more than 80%, and they're all paying LMI. And traditionally, that's how it's been. And as the property prices escalate, it is more common and common. Because it is impossible for someone to have $200,000 to $250,000 deposit, which usually is a 20% of most property values these days.
Correct. Parental guarantee, what is that?
It's becoming very, very popular now. Again, because we've been in the business quite a long time, and second generation is now becoming eligible to buy properties. So it's become very popular lately, especially because property values have gone up significantly. And again, for the same reason that people just don't have that deposit. So parental guarantee is a wonderful policy or process where parents who have a property with a lot of equity in it, they can help their children also get onto the property ladder by acquiring a property, be it an investment or owner occupied. How it works is, again, I put the example together. So let's say there's a young person who is wanting to buy their first home, and the value of that home is about 700, for example. Now, ideally, he would need 20% of that 700 to make up the 20% and borrow 80%. So this person needs now $140,000 for 20% deposit, plus the stamp duty, because over and above a certain value, you don't get any benefits, plus the settlement cost. So altogether, this guy might need about $160,000 to $170,000. Most young people don't have that, but his parents owns a property which is probably worth $1 million. They might have a very small loan on it, or maybe no loans on it. They have got plenty of equity sitting there, so we can then utilize that equity. How it works is, we'll take a security on the parents' home, so they have to give us the titles to put a mortgage on their home, and we'll also put security on the person who is buying the property, which is children in most cases. So now bank has enough security between the two, and we can lend 100% of the purchase price to the borrower. So let's say he's buying this property for 700. We can actually give him whole 700, as long as his income can service that loan. Of course, we still need to check that. And if the income is sufficient and serviceability is evident, we can also fund the stamp duty for that property. So they can go up to about 110% roughly in most cases. Parents are always guarantor for only 20% of the borrower's loan. So they are not giving away the whole $1 million of worth away. When the guarantee documents are drafted, what bank is doing, let's say this young person has just bought a home for 700, they took a loan of, let's say, 730. Bank is securing 20% of that 730 by the parents' property, which is roughly what, 150-ish, and the remaining is secured by the borrower's property. So that's how the structure will work. On the loan documents, it won't show percentage, it will just show what are the securities, but the securities are split in that fashion in the background on the system. Fast forward 3, 4, 5 years, the borrower's property has appreciated. From 700, now it's probably 850 or 880. The loan has reduced from 750 to, I don't know, 650, because they put extra money in there. So if you look at their loan and their value of their own property, now they are below 80%. At that point, or whenever they reach that point, we can restructure that loan and release the guarantor.
So when you are using the equity from parents' property, do they pay interest on that 20%? No, so it's
the loan is complete responsibility of the borrower. It's one loan of the whole amount, which is just borrowers. So the liability is borrower. They are just giving a portion of their equity, so that this person does not have to come up with a 20% deposit.
Like as a collateral, just blocking that, so they can't sell it anywhere, but just blocking it unless they release it.
That's right. That's a very good point you have raised, because guarantors must know that once they become a guarantor, bank has a charge on their title. Yes, their guarantee is limited to 20%, but at the end of the day, let's say they want to sell their own home, bank will say, look, you can, but you will need to reduce your children's loan by an X amount, say 20%. So whatever they are receiving from sale of their own home, 20% will go there. Unless at that time the borrower's property has appreciated enough that they don't need the guarantor, then we can just do the whole restructure and discharge all at the same time. But if that hasn't been achieved, then the guarantor could be in a bit of a, and these are the things we'll discuss with them right at the start, that hey, do you have any plans to sell? Yes, you do. Okay, well, this could be an issue then. And if they know it about upfront, in some cases people have backed off and said, okay, well, in that case, we are better off selling and just giving him some gift, so he can use that cash.
At least they have time to make a backup plan, just in case things happen, they have a plan in place. In those, so for example, when you mentioned, if the parents have their loan, say with NAB, and you are with ANZ who's using the equity, what's the process there?
Well, we'll have to refinance the parents' loan, if they have a loan on their property, from NAB to us. And it will be no different if they were with us and the child or the borrower went to NAB. Because both titles had to be secured by the same bank for them to be able to use the equity.
But sometimes the parents are retired, have no income. What happens with them?
We have to ascertain that, look, if the guarantee was ever called upon, can they service the guarantee? If they can't, they are not eligible guarantors.
Oh, so there are restrictions with guarantors as well. So
for example, if the guarantor has a big super portfolio and raising an income of 100, 250 grand from it, and they have no other liabilities, then we know that, hey, look, with that income, they can easily service the guarantee amount. If they have absolutely no income and they themselves are pretty, cash strapped, then we'll say, sorry, you're not an eligible guarantor. We're probably putting you in a situation which might not be good for you.
Okay, even if they have no loan on their property, it's a $1 million property, no loan at all, fully paid off, they still can't be guarantors.
If they cannot service the guarantee amount.
Okay.
So they have to have some sort of income to live, and that income needs to be enough for them to live plus to service the guarantee.
The loan.
So there is a very detailed questionnaire we have to go through to make sure that the guarantor is eligible.
Okay.
Sometimes guarantors are working, they have good incomes, but they don't have enough equity in their home to be guarantors. So that sometimes also stops them to be a guarantor.
Yes, okay. And who should look for a parental guarantee scenario?
Look, usually anyone who has that opportunity. So look, you will not look for it if you do not have parents living in the country or they don't own a property. So first of all, they need to be here and they need to own a property. From there, we can look into the details of what the value is, what the loan is. But ideally, it would be anyone who does not have a lot of deposit, or they have deposit but it's not big enough and they really want to get to that 80% mark. Because the beauty of parental guarantee scenario is that anyone who borrows with this setup, they pay no lender's mortgage insurance because bank is fully covered, and their interest rates are also based on as if they are borrowing 80% or less. So they are benefiting from that without really actually putting in 20%, because their parents have been kind enough to offer the guarantee.
There's one more thing that you mentioned earlier about stamp duty being included if there's a parental guarantee. Is there any other, because what I know is that stamp duty is usually not financed by the bank. That is something the buyers have to arrange themselves. Is there any other scenario that the stamp duty is paid by the bank?
Look, if you can secure the loan amount with your other properties or with parents' guarantee, then you can borrow it. If there is no security for it, then you can't borrow it. So think of it like this. You're only buying one property, you have nothing else. Can bank lend you stamp duty? Well, if they are lending you stamp duty, it's the same money that you're putting here but then reborrowing. So overall LVR needs to be looked at. But if you own multiple properties and there's enough equity between them to borrow, then of course you can. So security is the main thing. So at the end, we'll come back to that LVR. How much are you borrowing? Is the bank having enough security to lend you this? Yes, it is. And it's within the allowed limits. Done. If you can't and you don't have other securities, then obviously bank will never lend you 110% unless there's other properties that you own or your parents are coming in as a guarantor.
Good to know.